Hello everyone, and welcome to tonight's presentation. My name is Steve Molinario, and I'm the Portfolio Administrator in Ironwood's Investment Division. It's my pleasure to introduce our speaker, Mr. Sean Kenefick-Rogers. Sean is a charter holder of the CFA designation and is the Chief Investment Officer for Ironwood Wealth Management. So, without further ado, please welcome Sean and enjoy tonight's Quarterly Market Insights presentation.
Thanks, Steve, and welcome everybody to this edition of the Ironwood Quarterly Insight Call. Thank you for taking the time out of your day today to tune in. Now that it's still the beginning of the year, so we're going to focus a little bit on 2012 in review, and we're going to give you some of our thoughts in regards to 2013, the upcoming year, and what we're looking for. But before we do that, I want to take us all back to August 5th, 2009. First, I'm going to show you disclosures. And then I'm going to take us back to August 5th, 2009. The S&P 500 was at 1,003. And in our Ironwood Insights call, we showed this slide to everybody. We said, what do you expect the time to be before we get to all-time highs again? And we took a poll, and most of the answers were longer than 5 years at the time. And now looking back on this, the actual answer is probably going to be closer to 3.5 to 4 years. So over that period of time, we've gotten somewhere between, call it 16 and 22% return from the S&P 500 from this period of time where we're looking back in the future. Now, we point this out not to show what great returns we've got over the past 3 years, because all they did was make up for the the bad returns that we had in 2008. Really, the reason that we want to show this is so that everyone knows these times are inevitable, and when we go through future turbulent markets, we want to remember that we've been here before, and that staying the course is usually the best option and usually ends up paying off. Alternatively, you could be like some folks during this period of time who were really scared when the S&P was at 1,000, and they decided to go all the cash. And just recently, they may have said, hey, you know what? Fiscal cliff's over. The market's at 1,500. I'm feeling a lot better. I'm going to go ahead and buy in. But they're buying in at 1,500 versus 1,000 at a point when they might have sold. So we don't bring that up to show what great returns we've had over the past 3 years. We really bring that up to show you that all of you have made a great decision to stay the course, and through proper diversification, the right time frame, we were able to weather one of the worst recessions that we've seen. So I just wanted to bring that up before we got into today's presentation. Like I said, we'll go through returns and environment in the fourth quarter of 2012. We'll also kind of do a year in review. We've got a lot to go through today, so I'm going to go through some of these slides fairly quickly. If you do have any questions, please go ahead and write those in. Your GoToMeeting taskbar should have a place for that, and Steve will answer those, or Steve will ask those at the end of the presentation, and I'll answer those. We're going to go over what lies ahead, or what we think lies ahead in 2013, and how that's going to affect our investments. First, let's talk about the fourth quarter of 2012. The S&P 500, believe it or not, ended the year at 1426. Last year at this time, we believed that the S&P, based on earnings and PE ratios, and at the time the economic environment, we were calling for, in which we were predicting that the S&P 500 would be at about 1525, and it ended the year at about 1426. It's always a dangerous thing to try and predict what's going to happen with the market a year out. Case in point, 1 month later, as of today, we're at like 1510 on the S&P 500. So I'm a lot closer to that number that we gave back 1 year ago than we were at the end of the year. And that's the problem with forecasting, where the S&P is going to be 1 year from now. There's so much noise in the market that we get a thing like the fiscal cliff to get past us, and the market goes up 5% in a month. So with all these things that we're saying in the quarterly insights, remember that these are our best guesses based on the economic environment we have in front of us at the time. So with that, equities were mixed for the fourth quarter. The S&P 500 was actually down for the quarter, while the small cap index, the Russell 2000, increased by 1.9%. Emerging markets gained 5.6%, and developed non-U.S. countries gained 6.6%. The 10-year Treasury increased from 1.65% to 1.76%, and rates have continued to rise at the beginning of 2013. In fact, we've hit 2% a few times the past couple of days. So there's been about a 35 basis point increase to the 10-year Treasury in about a 4-month period of time. ISM numbers, very good leading economic indicator. We're very strong in December and January. We had a number of 50.7 and 53.1 for manufacturing in December and January respectively. And we had a number of 56.1 and 55.2 for non-manufacturing in December and January respectively. And in fact, the December 56.1 was the strongest reading we've seen in the ISM non-manufacturing index in over 9 months. That's a very good sign, since a major part of the U.S. economy is services driven. U.S. job market picked up at a modest pace the last 3 months of the year. We gained about 200,000 jobs per month over that period of time. In January, we slowed a bit, or at least the first reading is that we slowed a bit. We came in at 157,000 new jobs. But on average, we're still looking at stronger job creation than we had in previous months, which is a good thing. Like I said, developed international was up 6.6. Emerging markets were up 5.6. REITs were up 3. Small cap was up 2. Bonds were only up 0.2%. Cash was flat. Market neutral was flat. The S&P was down a bit, tiny bit. And then commodities were down 6.3%. Most of you may have noticed when you went to the gas pumps, not more recently, but maybe a month ago or so, gas prices were starting to come down. Now they're starting to increase a little bit, but we had a big decrease in gas prices about a month ago, which will help consumers out. U.S. economy definitely is improving. We did get a little bit of a scare a few weeks ago with the fourth quarter first reading of GDP. However, the third quarter we grew by 3.1%, which is pretty good. And then the preliminary number, like I said, for Q4 was negative 0.1%. There's several reasons why that was negative 0.1%. Government spending decreased by 15% during the quarter. Military spending decreased by 22%. We believe that this had a lot to do with the fiscal cliff, and the government was getting ready to start reducing spending because as of January 1st, spending cuts were supposed to start in both defense and non-defense. So we think that part of that decrease in GDP in the fourth quarter will be regained in the first quarter because we've pushed off those spending cuts for 2 months. Another thing that hurt the GDP was inventories. Inventories have been coming in at around $60 billion per month, and they dropped from to 60 billion to 20 billion. And so that is also an indicator to us that corporations were also worried about the fiscal cliff, and they were slowing down production and inventory. They were letting inventories deplete a little bit more than they had in previous months. So we believe that'll be a positive going into the first quarter of 2013 as well. And so the stock market, the S&P was down 0.4% during the fourth quarter. A lot of these reasons, the government spending down by 15%, the inventories at 20 versus 60, that's why you saw the stock market kind of decrease in November and early December, only to regain new, relatively, not all-time highs, but 5-year highs over the past month and a half. What's different about the past month and a half? Well, we've gotten a lot more clarity when it came to the fiscal cliff and the fiscal cliff issues. So that's really where we saw the stock market take off, is when some of that uncertainty was pulled off of the market. Another headwind that could cause some slower growth is everyone probably notices, if they look at their pay stub, that taxes did go up. That was the payroll tax that we had on holiday for 2 years, just coming back to normal. So that will be a headwind. But like I said before when we were talking about commodities, gas prices have come down a bit, which will also kind of offset that extra increase in taxes as long as gas prices stay a little bit lower here. So all in all, we think that the U.S. growth is improving. However, it's still not going gangbusters. So we're slowly moving forward. It's kind of the story. The cyclical sectors are where we have a lot of positive influence. Auto sales were at 15.5 million units in November, annualized, 15.4 million in December, and 15.3 million in January. So those are really strong numbers. 2012, the total output for autos was 14.5 million, up 13% from the previous year. Inventories, we talked about inventories. They went basically from 61, where you see here, all the way down to 20. And we believe that has a lot to do with the fiscal cliff and corporations preparing for the fiscal cliff by not producing as much output. Therefore, inventories weren't as robust as they've been in previous months. Housing numbers, however, were not like inventories. They were very strong. In fact, in December, we had 954,000 new housing starts. That's the highest number we've seen since June 2008. That's a very good sign, considering that this recession was started with the housing market. So we're very optimistic about that. This slide just goes into the housing market a little bit more. Mortgage rates are low. You can see that here up in the top right. Mortgage rates are low, which is making monthly mortgage payments relative to an equivalent rent payment. There's a big gap there. So investors are coming in, buying houses, and renting them out, which is driving down home inventories. We're down to 2.2 million units, which you can see the trend here is very positive. Supply goes down. What happens to prices? Prices go up. Case-Shiller index, the 10 and 20 city index, were both up around 4 to 5% November to November. Phoenix was up an astonishing 22% from November to November. So we want to make sure we don't get too excited about these numbers, but housing is definitely showing improvements, and that's going to have a huge impact on the U.S. economy, positive impact. Low interest rates not only is helping the housing market, but it's also helping the consumers and consumers' balance sheets. Total assets measured up here, you can see that as of 12/31, if you add up all assets for consumers, we're at 78.2 trillion, and you can see the peak was only about 3 trillion off. So the net wealth effect for folks is starting to come back. People are starting to feel a little bit better because, hey, their house might be worth a little bit more, their 401k might be worth a little bit more. They might have been able to refinance their house, and their house payment is actually a little bit less. So people are starting to improve their balance sheets. You know, this has happened over a 4 or 5 year period of time, and folks have deleveraged, folks have paid down debt, folks have increased savings, and we're starting to see better economic data from the consumer because of this phenomenon. Most of this has been accomplished through low rates. We'll get to the Fed a little bit later, but low rates have helped this most recent recession for the U.S. economy to get out of it. So we're moving from consumer finances to corporate finances and corporate balance sheets. And you can see here that low interest rates have helped corporations as well. Corporations have raised $3 trillion in new bond issuance, whether it was to refinance old bonds that they had outstanding at higher interest rates, which helps their bottom line, whether it was to buy back stock and put more emphasis on earnings and increase the net profit, but decrease the amount of shares that are outstanding, whether it was to provide a dividend to shareholders and repay those shareholders for investing in the company, or whether it's for CapEx spending and increasing the business. And so you can see here, leverage has come out of the system. So we're not getting debt just to refinance. Companies have been paying down debt. They've also, because of low interest rates, their net interest to earnings before interest and taxes, their coverage ratio, their interest coverage ratio has improved tremendously. They have more money in current cash accounts to pay for their interest versus where they had in the past. You can see the average here is between 3 and 4, and right now we're at 6.8. So companies are looking very, very good when it comes to current assets versus current liabilities. Internally generated funds from companies, you can see we have plenty of cash to fund capital expenditures. In fact, there's a huge gap here suggesting that CapEx spending should start to increase, or some of these other things should start to happen. This is creating huge cash balances on corporations' balance sheets, and they're either going to have to do stock buybacks, pay a dividend, or invest in the business. We're hoping to see some of that start to come to fruition now that we have some of this fiscal cliff uncertainty out of the way. Federal finances. This one doesn't look as good as corporations or as consumers. The main problem is over here on the right. We're bringing in 15.8%, and we're spending 22.8%. Now, a lot of this has to do with the recession. During a recession, most fiscal authorities are going to want to spend money to fill the gap that corporations and consumers are going to leave because there's a recession. So they're deficit spending. And the hope is that they deficit spend to reduce the effect of the recession, and then they're going to bring back growth and bring back these receipts or the inflow. And then after the recession after we've recovered from the recession, they can then start to decrease the deficit spending. Now, we had some major deficit spending during this recession. You know, $1 trillion deficit spending each year. And so this is where we really have been focused. This is what the fiscal cliff was all about. This is what the sequestration is all about. we've got to bring down our spending and bring up our receipts. The best way to do that is through growth. One of the things we saw with the fiscal cliff deal is we saw what could have potentially thrown the U.S. into a new recession, which would have hurt growth. We saw that avoided. It's depicted here. Here's where we were as the deficit for 2012. If we would have gone over the fiscal cliff and had everything changed the way it was supposed to prior to the deal on beginning of January, we would have gone from a deficit of about 7% of GDP down to about 3.5% of GDP. The New Year's compromise, we built that and we made it a ledge versus making it a cliff. In fact, next year we're projected to we're projected to have a bigger deficit next year than we would have if we would have gone over the cliff this year. And you can see what that's going to do to long-term federal net debt and what it is as a percentage of GDP. So we're at about 72.5 under the current New Year's compromise scenario. 10 years from now, we should be at around the same level that we are at now. If we would have gone to baseline and we wouldn't have gone through a recession and we would have still stayed at decent growth rates, we could have been at 58.3. The only thing is a lot of economists were expecting that if we dropped off this cliff, it would throw us into another recession. And when you have a recession, what do you have to do? You have to spend money. And so we end up in a vicious circle. So Congress, the Senate, and the President decided on a compromise so that we would, yes, go down, but not as bad as the fiscal cliff would have taken us. Unemployment or employment. These are the old numbers as of November. We have January's number, what came in at 7.9%. The unemployment number is a very volatile number, so we're not so concerned with the unemployment rate. It fluctuates based on how they do the survey. What we're more concerned about is how many new jobs were added. In January, there were 157,000 jobs added. A lot of economists came out and they were saying, that's not really that great. The jobs report wasn't that great. We took the report a lot differently. The report actually had some revisions in it that added 200,000 jobs to the previous 3 months. So we basically got an extra month worth of job growth just by revisions. Not only did they revise the last 3 months, but they also do a revision on an annual basis going backward, and they revised April 2011 to March 2012 by 422,000 jobs. So in January, not only did we get 157,000 jobs for January, which isn't great, we'd like to see it higher, but it's not horrible either. We got an additional about 600,000 jobs that were added to the economy that we didn't know that we had. So this 5.1 number is really more like 5.8, which is getting us closer to that 8.9 that we lost during the recession. I'm not saying that we're there, but 5.8 is a lot better than 5.1, and we're starting to see a lot better numbers a lot better job growth than we had maybe a year ago. So that's showing some optimistic, and we believe that's going to continue now that the fiscal cliff uncertainty has been pulled off of the market. Inflation is not a concern right now. We're below 2%. I'm really not going to talk about it too much. It does play into the Fed here. The Fed has been very accommodative for a long time. Not only the Fed, but other central banks. The Fed decided to do more QE, or quantitative easing / printing money. Basically, they print new blips on the electronic blips in the system, and then they pull out treasuries. So they're buying treasuries with money that they basically printed, or not even printed anymore, just created through electronic blips at $85 billion per month. They have a target of 6.5% unemployment. They said that in the last couple of reports, saying that they really want to be accommodative until unemployment gets down to about 6.5%. But they're being very vague about how long they'll continue to do QE, or if they'll reduce it. You know, if we get down to 7% unemployment, they haven't really given a game plan. They're being very vague when it comes to what they're actually going to be doing when it comes to buying bonds and printing money in the future based on how data comes in and how the economy improves over the foreseeable future. So we're hoping to get a little bit more clarity out of them, but as of now, we're not. And that's why inflation at under 2% doesn't concern us. However, if things with the monetary supply start to change, inflation could come into the picture very fast. We want to keep an eye on it, but we're at the moment we're not too concerned with it. Central banks around the world are in easing mode, and you can see that here. Central banks, we just talked about the Federal Reserve, and that's the increase in their balance sheet. But if we look at the ECB, they increased majorly during the sovereign debt crisis. They've since started to reduce this a little bit. Bank of Japan has increased, and in fact, they just pegged their inflation rate. They changed it from 1% to 2%, which has really devalued the yen recently by almost 20%, or it's 20% year over year, and most of that has come in the last 3 months. And that was, you know, all based on something that they said they may do a year, 2 years from now. So we do really want to watch global monetary policy. Things are real easy right now, and we think that that's a big tailwind for stock markets, for asset, you know, commodities in the near term. But we do want to watch where these things go. Now, because of these substantial policies, these unprecedented policies, there are imbalances that have occurred. In particularly, you can see here precious metals and industrial metals. Since the recession, these things have gone up tremendously. But you can see that energy and grains and livestock haven't really followed in suit. So there's an imbalance here. The imbalance comes from this global monetary supply for the most part. I want to focus here on this precious metals, and I want to focus more on gold. If this chart doesn't scream bubble tendencies, then I don't know what would. This is gold and gold inflation adjusted. And you can see that on an inflation adjusted basis, we're getting close to the all-time highs for gold. Gold doesn't produce anything. Gold is a very speculative investment. It's a good insurance position for a portfolio. Right now, we believe that it's a very expensive insurance position inside of a portfolio. We would not be surprised to see gold pull back, not unsimilar to back in the 80s. But it's just not an asset class that we would be too interested in. We think it's too speculative at this time. We have some gold in the portfolio as a hedge. We've had it. We are not increasing our position, nor are we decreasing our position. It's more of a hedge, and that's what it'll be. Sometimes bubbles can go on for longer than you think, and we want to make sure that we're rebalancing the portfolio. So as we rebalance the portfolios, you know, we'll be selling gold to get it back to where we think it should be as a percentage of the entire portfolio, and that's how we'll decrease our percentage of ownership in that speculative bond-like scenario. Other imbalances that we've seen because of the Fed and other global monetary policy is the bond market. More recently, if we look at 2007, 2008, down here we see this dramatic drop in interest rates from about 5% down to 1.76%. If you're a bond investor, this is a very good chart for you. If you've been in bonds for the last 5 years, for the last 10 years, for the last 20 years, for the last 30 years, interest rates have come down, 14%, 15%, depending on when you're looking at it, over this time frame. That's been a huge tailwind to bond performance. However, just recently, we've had a 4-month period where the interest rates have gone up, where the 10-year Treasury has gone up 35 basis points in a pretty short period of time. But we want to make sure that we have the correct, or we have the right kind of bonds in our portfolio for any type of situation that may unfold. We believe that interest rates will be going higher in the near term. In January, bonds lost money. The Barclays aggregate lost about 1% total return in the month of January. That's just 1 month. And it could get much worse. I pull this chart up. We look at the broad market here. This is just showing us the impact of a 1% rise or fall in interest rates. So let's look at, let's say interest rates increase by not 1%, but let's say that the 10-year Treasury goes from 2 to 4. If that happens, we're going to lose about 10% in price of our aggregate broad market bond fund. And so those are things that we want to be aware of and make sure that we have some bonds that might not be as impacted by increases in interest rates, not inflation, in interest rates. So short-term bonds, mortgage-backed securities, high-yield securities, some of these bonds that have lower what's called duration is where we want to be focused. However, with that said, we still, interest rates could go down some more if we were to go through another recession at these levels. So we don't want to abandon bonds altogether either. It's all about diversification and trying to take advantage of what we think is going to happen based on what facts we have in front of us. High yield bonds, we've been in high yield bonds. We've been overweight high yield bonds for a while. They've become less attractive now, and the reason is that the spread between a Treasury and a high yield bond, on average, is 5.9%. Right now, it's only 5.5%. So we're not getting paid for the risk that we're taking. The reason is the default rate is at 1.1%. All these companies have been able to refinance and improve their balance sheets at better rates. So they're not defaulting on their new obligations. They're lower obligations. However, 5.5% is just not what the historical average has been on top of a Treasury in order to compensate us for the extra risk that we're taking by having a high yield bond. So even though default rates are low, recovery rates are high, we still want to make sure that we're not just piling into high yield. A lot of investors have piled into high yield over the past year, and it's done very well. We want to make sure that we're taking some of those profits and putting them elsewhere. So we're not overweight, we're not underweight, we're about neutral for high yield because, yeah, we're still clipping away at 5.5% higher than a Treasury, but we're not as comfortable as we were when yields were higher, when the yield spread was higher, I should say. International. Mario Draghi announced back in September of last year that the euro was irreversible. And ever since he did that, stocks have done very well in the international markets. If we just look at the fourth quarter last year, we can see that EFA did 7% better than the S&P. So we have EFA up 6.6, S&P down 0.4. So you outperformed, if you were in EFA, the S&P by 7%. China outperformed by 13.3% compared to the S&P, and France returned 11.3% better than the S&P. I only bring this up because a lot of folks were hesitant to put money into international markets in the fourth quarter of last year, and even in the second quarter of last year, because there was so much headline risk. There was so much bad news coming out. No one wanted to invest in Europe. No one wanted to invest in China. Those were places that all the news was coming out and it looked like bad news. Well, when news comes out and it's bad, the stock market prices in immediately, or pretty close to immediately. And so when you don't have as bad of news, or when it starts to improve, you start to get improved markets. In the past 6 months, we've looked at international markets and seen the PE ratios, the valuation metrics, is very attractive. And so we overweighted some of our portfolios in international, and it paid off to do so in this last quarter. Another implication of Draghi's comments about the euro being irreversible is the sovereign yields for countries. Back in June 30th of 2012, rates blew out, and you could see that, by this increase here, and we had these rates. Since Mario Draghi came out with LTRO and said that the euro was irreversible, those rates have come down dramatically. And I've got a screen here that shows this. It's not the greatest pictures here, but I'm going to go ahead and read off these different how much the sovereign yield has come down. Portugal, 204 basis points. Ireland came down 113 basis points. Spain came down 111 basis points. Italy came down 135 basis points. France came down 82 basis points, and Germany came down 28 basis points. So every single one of these sovereign yields came down over this 6-month period. Has everything to do with the confidence the market sees now that Mario Draghi has said that the euro is irreversible, and the markets believe him, that they're going to do whatever it takes to keep the euro in place. They still have work to do with a fiscal union over there, but this is definitely a step in the right direction. China, I want to talk about China a little bit because it's 10% of global GDP. China is not going to continue to grow at 7 to 9% GDP growth. It's a large economy. It represents 10% of global GDP. When economies become big, their GDP growth starts to slow down. You can't take a huge economy and grow it at 10%. It just doesn't happen. So although we have seen some slower GDP numbers out of China, we have seen a lot of good leading economic indicators, manufacturing, their inflation rate is a lot less of a concern now, as shown over here. It's down to about 2%, and tight policy that they had for a little while, they have started to loosen that, and you're starting to see things pick up over in China. And so a lot of economists are suggesting that we're going to have a soft landing in China versus a hard landing, and there's no, it's not a surprise that because of this, China stocks are up, or were up 12.9% in the fourth quarter. Valuations. Developed markets still look very attractive. You look at the IFA index here, and it's still under its long-term average, not as much as it was, but it still looks attractive. A lot of these markets look attractive. The U.S. looks attractive as compared to some of these emerging markets that don't look as attractive as some of the developed world for the risk that we're taking. Some of the valuations are pretty pricey. But some of the emerging markets look very attractive, like China, like Russia. Some of the BRIC nations look very attractive right now. And those are places that we want to be. This graph right here, really I want to focus down here at the bottom, and it's relative valuation. And I think a big part of the stock market's move over the past year, year and a half, has been because of relative valuation. Pension funds, investors, retirees, you know, you're looking at your different investment options out there, and you've got REITs, which are all paying dividend yields that are higher than the respective sovereign yield in that country. You even have stocks paying higher than the respective 10-year government bond yield. So on a relative basis, folks are, you know, with some of the fear out of this market, no fiscal cliff, no European sovereign debt issues or less of a sovereign debt issues, you're starting to see the market improve because some of these fundamentals, you know, where is somebody when I get some good yield, well, I'm going to want to buy stocks versus buying a 10-year treasury. If I have a holding period of 10 years, I feel a lot more confident that a stock's going to get me there versus buying a 10-year treasury or any equivalent in any other country. So that's that relative valuation theory of folks are moving out of bonds into stock now because they have to earn higher returns to hit some of their investment objectives. Deploying corporate cash. Well, you know, Apple was in the news today, actually this morning, because of their cash hoard. One of the big investors, one of the hedge fund investors out there, was trying to get them to think outside the box to possibly return some of this cash to investors in a very creative way. I don't necessarily want to go into the specifics about Apple. All I really want to do is point out that investors are demanding that companies do more with their cash than just have it sit there and create this big war chest for them to sit on. Cash yields are yielding, you know, 1% or even less, possibly, and it's going to drag down your overall performance as a company if you've got a huge amount of your balance sheet in cash. So investors are starting to demand either spend the cash or return it to investors as a dividend or as a stock buyback. So we believe that capital expenditures are going to follow in suit now that companies are going to feel like some of the uncertainty has been lifted and they're going to be more comfortable spending some of this cash hoard that they've amassed. They're going to, we've already seen buybacks and dividends increase, and that's going to be a positive for stocks. Not only are corporations sitting on a lot of cash, but individual investors are sitting on a lot of cash. And I alluded to this in a couple of slides prior. We're not going to hit our investment goals earning 1%, maybe worse. You know, this is a $100,000 investment in a 6-month CD is going to earn us $450. That's not very good. That's not a very good return of money. You're losing to inflation if you put your money into that CD for the year. And we can see, yes, some of the cash that we built up during the recession has been put to work. But even if you look at the levels that we're at right now, we're still at the same levels we were at in 2002 and 2003 during the last recession. So we still have a lot of cash that's on the sideline. In fact, there's $30,000 in cash accounts per person in the United States and another $3,000 in floating currency per person. So there's a lot of cash out there. We believe that that's going to be a tailwind for equities when folks start to put this cash to work. And put this cash to work, investors did in January. January, we had the largest inflow to equity funds that we've ever had, $77.4 billion. It's no wonder that the stock market was up, 5% during the month of January. The uncertainty of the fiscal cliff was pulled off, and stocks went flying. People said, okay, I feel a lot better about this market. We're going to invest. Well, we've already been invested in equities, and we've been enjoying this ride that we got in January in our stock portfolios. So even though the past 6 years or so we've seen a huge inflow to bonds versus stocks, if you look, there's been $193 billion into stock funds and ETFs since 2007. In 1 month, we did $77.4 billion. So in 1 month, we did, roughly a third, a little more than a third of what we did the previous 5 years. So that's definitely telling you that there's been a turn here, and that people are starting to get cash and or bonds back working for them. And once again, that probably is a major factor in why we've seen stocks go up 5% for the month of January. We believe that there's still a lot of cash and bonds that need to be put into equities, so we're not too worried about this record month. However, if we start to get a couple of record months, that could be a contrarian indicator. The stock market could hit some of the levels that we'd like to see it at, and we could go to a neutral stance in our equity portfolios. But right now, we still believe that there's more opportunity in stocks than any other asset class that's out there currently for the risk that we're taking and for the income we're receiving from the dividends. Some more valuation metrics. This is just showing more reason why we prefer stocks over bonds, over fixed income. If we flip the price to earnings multiple on its head and we look at the earnings yield of the S&P, it's at 8% versus the Moody's BAA yield of 4.6. This is a huge spread. Typically, this is showing that relative valuation, stocks more attractive than bonds. Last time we saw this big of a gap was in the 2000s when stock prices were through the roof and bonds were yielding, or this bond, Moody's BAA yield was close to 9. And so at this time, we really should have been buying bonds and selling stock. But this time, we really should be selling bonds and buying stock as much as our risk tolerance will allow, at least. Trailing PE multiples, if we look at where we are currently, or at least where we were December 31st, 2012, we're at 13.1. That's above recessionary levels, but it's not even close to where we're usually at during expansion, so we still have some multiple expansion that we could see, which would help the stock market. This is a good one, and I've taken it a little bit of a step further than what I've shown in the past. Current PE ratio of 13.1. These two graphs, this one is showing 1-year returns, whereas this one's showing 5-year annualized returns. So when we have a PE of 13.1 and we plot, what the rate of return should be at all the times when we had a 13.1 PE, or if we graph this and do a regression of PEs versus what our rate of return will be the next year, we get this scatter plot that we can't make any sense of. And yeah, there's a somewhat of a relationship, but the standard error is 17.2. So what this is telling us in layman terms is basically we can't predict what the market's going to do over a one-year period of time based just on the PE ratio. However, if we say, okay, well, what about if we don't say 1 year period of time, but what if we say 5-year periods of time? 5-year, now we start to see a relationship, and the standard error is much smaller. So just for fun, I said, okay, well, why don't we take the S&P 500 at the end of the year, which was 1426, and why don't we assume that we're going to get an implied annual rate of return of 13.2%. If we do that, our January 1st, 2018, the S&P 500 should be right around 2,600. I think there'd be a lot of happy people out here if the S&P 500 is at 2,600. And this is a pretty decent relationship 5 years looking forward. So this is one of the reasons, just one of the many reasons that we really do believe in stocks right now, with the caveat that you really want to make sure that you have the risk ability to, and you want to make sure that you're not going out of your risk tolerance to eke out more returns if you don't need to be doing that. But we do really believe in equities right now. This slide, I use it in every single one of our presentations. It's just showing that diversification, diversification, diversification. You know, if they say in real estate it's all about location, 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 in investing it's all about diversification, diversification, diversification. 2 portfolios, return of the portfolio on the left is 6.75% annualized, with a standard deviation of 10.94. Another word for standard deviation, you can say, okay, well, this portfolio, the risk of this portfolio is 10.94%. You can think of it like that. So we got the return. If we add more asset classes, we get a higher return with a lower volatility or lower risk. Your portfolio is not jumping all over the place as much as this portfolio here. So that's the best of both worlds, a higher return and less volatility. That's what we're aiming to do. The second chart here is just showing 20-year annualized returns by asset class. We've got REITs, oil, S&P, gold, bonds, international, inflation, and housing. And then we have the average investor. The reason the average investor hasn't gotten as much return as any of these asset classes is because they make emotional-based decisions. They sell when they should be buying, and they buy when they should be selling. That's why when we see $77.4 billion go into stock funds, it definitely throws a blip on our radar. But because of some other stuff that we see in the markets, we're not too concerned with it. If we get 3 or 4 months in a row like that, and the market goes up to 1,600, 1,650 on the S&P 500 over a short period of time, that's a time when we may get less enthusiastic about stocks. But we're just trying to show emotional-based investing usually doesn't work out. The whole point of this chart is, and I have this one in every single one of our presentations, have the correct time frame. If I'm planning on having money that I need next year, it should not be in the stock market. It should not be in the bond market. They're too volatile. I don't know with enough certainty what I'm going to get from those assets. If I need to use the money next year, I don't want to have to sell at a 37% discount if it's 2008. So we want to make sure that we have the right time frame. If we push it back to 5 years, a 50-50 portfolio in any 5-year rolling period from 1950 to 2012, the worst annualized rate of return for a 50-50 portfolio is 1%. So that's, looking at it for 5 years. If you have a 20-year time horizon, you want to make sure you're taking enough risk. Because if you're not, you could, if you were just 100% invested in bonds and you had a 20-year time horizon, your average rate of return over this period has been 6.2 versus stocks, which have gotten you 10.8. Now, it might not sound like a lot, the return difference, but over 20 years, every single year outperforming by, 4.5 or so percent, look at what it does to the growth of 100,000. You've got more than twice the amount of money in stocks as you do in bonds. So this graph is all about having the right time frame and making sure your portfolio matches your time frame. Investment implications. When I speak to clients, I kind of say we're kind of in the fourth or fifth inning here. Stocks are still undervalued, but we're becoming closer to neutral valued. Bonds are still overvalued, but we're finally starting to see some interest rate increases. So our stance hasn't really changed all that much on what asset classes we want to overweight versus which ones we want to underweight, but we definitely have seen a shift over the past couple of months now that some of the uncertainty has been pulled off the market. And so the playbook going forward might start to change with which asset classes we want to overweight and underweight. As for now, we still want to keep the same kind of playbook where we're overweighting some commodities, floating rate bonds, market neutral, and underweighting long duration fixed income, treasuries, and precious metals, in particularly gold. Another slide that we always have in our presentations is this definitely has to do with diversification. You can see that if we look at the past 10 years, we've got some asset classes that tend to be either on the top or on the bottom. Just look at emerging markets. Top, 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 bottom, top, close to the top, bottom, top, top. So that's a lot of volatility. Yeah, you earned 16.9% if you were invested in it the entire time, but to get that 16.9%, you had to have a negative 53% year, a negative 18% year. That's extreme volatility. Versus cash. Cash is always on the bottom here, except for when we had a bad market, it's at the top. So it's bottom, 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 top, bottom, bottom, top. And you look at the long-term rate of return on cash, it's been 1.7%. Well, if we have a portfolio that's diversified, say 25% S&P 500, 10% small cap, 15% developed international, 5% emerging markets, 30% fixed income, 5% market neutral, 5% commodities, and 5% REIT, we end up with this asset allocation portfolio, which just so happens to always be kind of in the middle. And over the past 10 years, where many people would think, gosh, I haven't really gotten anything out of my investment accounts over the past 10 years. Well, you actually, if you had a diversified portfolio and you made sure that you weren't selling, in 2008 when the asset allocation portfolio was down 24%, you would still earn 8.1% annualized over the past 10 years. That's a good return. That's a return most people would be pretty happy with. So with that, I'm going to end and leave it up to questions here. Steve's going to go ahead and read the questions that we have.
All right. Thank you, Sean. That was very illuminating. We've had a couple questions come in. The first one is, Sean, you showed us a chart of U.S. debt to GDP of about 73%. Could you tell me where a country like Greece or Iceland might rank on that kind of chart?
Yep, and this is the number one reason why bond yields blew out late last year is Greece is over 100%. Some of these countries Iceland, some of these countries are over 100% debt to GDP. However, they also have companies like Germany and some other stronger Euro countries that are in a much better fiscal position than some of these peripheries. And that's the tension, that's exactly the tension that you're seeing and that we saw in the middle of 2012 and in 2011 and in 2010. Seems like every year Greece and the Eurozone kind of pop into the markets. But that's one of the main reasons why, is because that debt to GDP level is at unsustainable levels, and that's why the Eurozone is making Greece do the austerity programs that they're doing. There's been a lot of research that 90% is kind of the number, and when you get above 90% is when if the U.S. were to get up to 90%, you could see bond vigilantes come into the market and drive up the interest rate of the U.S. debt. And if they drive it up, it just compounds the problem. Because right now, our government only has to pay back at 2%. You know, they're paying people 2%, and people are buying these bonds for 10 years. 2% is our interest cost. So if that went, you know, if they drove it up and our debt to GDP went to above 90%, and investors started selling, investors around the world started selling treasuries, and you could see that rate spike. That would just, we wouldn't be able to refinance our debt, and it would be that's the whole issue, and that's why when the U.S. was downgraded, folks were pleasantly surprised to see that bond interest rates actually went down, because basically the U.S. is the best house in a bad neighborhood. And most market participants believe that the U.S. will come out of this high debt level, and it won't go from 70 to 90, it'll go from 70, and what will happen is we'll have better growth than what's predicted by the CBO, and we'll end up around that 50-ish number, but we'll have done it with growth, not with austerity. So hopefully that answers some of the question, and I kind of went a little bit above and beyond there to kind of explain the differences.
Okay, it looks like we've got one more question, and that is, seeing my Ironwood portfolio seem to pay an unusually high number of dividends in the fourth quarter. Can you tell me why this happened?
Absolutely. That's actually very, very astute. A lot of companies late last year, with the fiscal cliff and dividend rates uncertain, a lot of companies did a couple of things. They either fast-forwarded all dividends that they were going to pay in 2013 to 2012, and they paid them at year-end, or they did special dividends at the year-end to get rid of some of that cash on their balance sheets and just give it back to investors. So yes, we had a much higher dividend rate in December than we normally have, and it was because of those things.
All right. I think that's all we have for questions.
All right, perfect. I thank everybody for joining the call tonight, and we will talk to everybody soon. Take care.